So should the Fed keep hiking in order to slow the economy, or pause to make sure the banking system doesn't break as a result? Joining me to discuss are Erin Sykes, chief economist with Nest Seekers International. She's here with me on set, along with our very own Diana Olick from Washington. And ZipRecruiter chief economist Julia Pollack has our read on jobs today. Welcome, everybody. Diana, Erin, let me start with you guys. And Diana, was this just a one-off?
On the housing starts, look, that headline number is a little bit misleading, up 10%. And that's because when you have multifamily versus single family in the same report, multifamily drove that entirely. Single family housing starts were only up 1% for the month. They were down 32% year over year. And building permits were also way down year over year. Multifamily is very volatile because one large building can really skew the numbers. And multifamily right now is actually being overproduced. We have more of that supply coming on the market than we've had in decades. It's the single family we're really focused on, and the builders are still very skittish right now about putting holes in the ground.
Right. Erin, describe the trends that you're seeing. And if you didn't know that the Fed had been, it's kind of confusing about what they should do here. The market has in some ways been surprisingly resilient, or maybe it's starting to weaken more now.
Yeah, so all of a sudden everyone's a supply and demand expert, right? But that demand component is driven by a sense of stability and knowing that you're going to have a job so you can make decisions so that then we could supply and everything can even out. Now, what we were just discussing with multifamily housing, that is really driven by the lack of affordability because it's all rentals. People can't afford to save. They can't afford the mortgage rates anymore. They were just caught too short. So I think we're going to see more of the same. We're going to see people continuing to choose to rent. Although I'm a big fan of the idea that mimicking the herd brings regression to the mean. So when everybody else is renting, that's when you should really focus on buying. We have a terrific opportunity for buyers right now. Compared to last week, 30-year rates are almost down a point due to all of this volatility. That won't last. I suggest you lock it in today. It's not going to be here next week.
So quick thing I want to highlight, and Erin, you're pointing this out, and I think it's important for our audience to connect the dots as well. First Republic is a big mortgage lender. So what has you worried as we watch today to try to figure out its future? What's at stake here?
Yeah, so, just to clarify, it's very different than Silicon Valley Bank. That primary client is 20 years old. It's a startup founder, and, they don't have revenue. So that's why they keep drawing and drawing. The First Republic is much more stable in the long term. They have high net worth clientele that is diversified not only across different banking systems, but within their investments. That said, I'm not making excuses for them. They are a huge jumbo loan originator because of that high net worth clientele.
Sure.
They also have a huge exposure to ARMs. So they have 40% of their mortgage business in 7/1 ARMs and 25% in 5/1 ARMs.
I wonder to some extent, Diana, if that's the problem. If they have a high exposure to fixed rate loans, then this is such a twist from the credit crisis, right? In this case, bank problems could come back on the housing market. Everyone who borrowed got a really low rate that they locked in, and now the banks are the ones left holding the bag.
Yeah, and again, this is so different than what we've talked about during the Great Recession when it was the quality of the mortgages that was at stake. Today, the quality of mortgages is just excellent due to underwriting and, as you said, due to extraordinarily low interest rates that everybody refied into in the first 2 years of the pandemic, and nobody really is going to refi out of those because rates are now so much more than they were. And I would just say one thing about the opportunities for home buying right now. I don't think we're still in such a great place. We did see mortgage rates pull back a little bit because of this banking stress, but they're still now, 6.5% compared to 4.5% at the start of spring a year ago. Affordability is still really rough. Home prices are still very high, and the supply of homes for sale is supremely weak right now. As we're getting into spring, when you usually see people put their houses on the market, we're seeing a huge drop in new sellers coming onto the market in March. They should be flooding the market.
Erin, do you want them to hike by a quarter point next week? Because ironically, if they do, maybe the 10-year yield drops, and that's how I guess I'm trying to say the mortgage rate might respond opposite to what they do with the rate hike. So it's.
Yeah, and that's what we see through the fall. I do think a quarter point is where we should settle out. We also have to remember that the Fed funds rate and the mortgage rates are not identical. They have a lot more inputs into mortgage rates. And a lot of times what we saw through the fall is even though Fed funds rate kept hiking, mortgage rates actually declined. So right now we're pretty much at historic medians for 30-year rates. It's a 7.77% is the average over the last 50 years. So we still have an opportunity to lock in a decent rate. It's not a home run anymore, but I personally hope we never see 2.5% mortgages again, because that's why we're in the conundrum that we're in today.
Maybe if we make them 40-year mortgages, maybe 50-year. We'll leave it there. Thank you both, Erin Sykes, Diana Olick. We appreciate it. As we